How are you, folks? Enzo DiCasanzo podcast. This is part 12 for the December 2022 Federal Open Market Committee meetings, and a historic day, I suppose, my 300th video. So this is number 300, going back about, I guess, half a decade of making these videos. I guess 2018 is when we started doing this stuff. So it's been a good run. It's been a good run. So yeah, let's get to the staff economic outlook. Oops, I don't want this. Yeah, so today we're looking at the economic outlook, and let's see. So what have we done here? We've worked on the developments, term premium, staff review of economic situation, financial situation, outlook, and then the current condition, the participants' view, and then policy action. So we're getting towards the end of we'll do number 12 today, and we'll see sort of what kind of an exam I can make from these 12, and we'll see. But I'll probably finish these off, maybe at a little bit of a slower pace. I could do this in just a session, but I'm going to spill over into this one also. Okay, so what are we looking at? It says the forecast for U.S. economic activity prepared by the staff for December was not as weak as the November projections. The recent data suggested the real GDP growth in the second half of 2022 was stronger than previously expected, but economic growth was still forecast to slow markedly in 2023 from the second half, from its second half pace. So, yeah, that seems about right. And let's take a look at that. So yeah, and actually we have some of this other stuff here, and we'll get to this. This was the financial accounts from the Federal Reserve. We'll break out and work on this a bit. But what I wanted to look at was this. Yeah. So, and what did it say? It said from the second half pace, from its second half 2022 pace. So obviously here was pretty good, and they're not expecting that in the second half of 2023 is really what they're saying. And we'll fill in all this data as we go along. We have the space to do 2023. So yeah, so we grew it. These are annualized. So it takes the quarterly change, right? And then it takes the quarterly change and then says what would happen if the year you're taking Q1 versus Q4, and then the year how it would behave for the year under that percent. It's really just like multiplying this by 4. Really, if I want to just loosely sort of do that. This second one down here, what is this? This is the nominal change versus the real change. So you could sort of compare them. These are all higher, and actually these are in positive territory, mainly because of inflation. So you can see how distorted of a view you could get, which is why the very smart people at the U.S. Central Bank use the real, the base year price, the real GDP measure, as opposed to just going to Walmart and saying, well, what's on the shelf for a box of Lucky Charms or a bag of potatoes or some Starbucks coffee or whatever it might be. And then obviously the big one here, this is so really the top 3 here, the personal consumption expenditure, how that's behaving. So in other words, the business areas are what's sort of getting the domestic investment, fixed investment, equipment, changes in inventories. Those are some of the numbers that drag down the overall GDP number. Our exports are always, you can see the exports are generally, relatively volatile. 18, then -7, and -5, then +13. The exports and the imports, it all moves around a lot. Okay, that's just something to keep in mind. So, these are both negative this time through. You had one and one, positive and negative, negative and positive. You get all that. The government expenditure doesn't move around a lot. You can see there's not a dramatic vol unless people retire or things of that nature. What we spend on defense, what we spend on state and local. State and local, you see, doesn't move hardly. It moves very little at all. Not much. And certainly during the Trump years, you didn't have too many negatives in that. So that's something to keep in mind. But people voted how they voted, so what can you do? But again, economic growth. You're going back to, our U.S. Department of Commerce models on the consumption and investment and exports and imports and government spending. That's really what that is. Now, financial conditions, S&P 500, the debt mark, it says we're projected to be somewhat less restrictive than previously assumed, as the effects of a higher path for equity values and a lower path for the dollar more than offset higher medium trajectory for interest rates. So you have three things happening here. You have the equity values again, but I just did I sent a note to my guys that the S&P is down 13% from January 2022. Okay, we're certainly forecasting it says higher interest rates, or in the medium term, which means the next couple meetings. And then we've discussed the dollar, which, and again, I for better or worse, and actually today we may actually we might actually hit this today. We didn't graph that dollar, but maybe we should, because it's an issue. It's you can't say that the strength of the dollar. Now there's a couple. I did it versus the euro. Yeah, I did it versus the spot exchange of the dollar versus the euro, and how much says U.S. dollars to buy 1 euro. So again, you were buying 123 a couple years ago. Then the euro the dollar strengthened, cheapened a bit, right? The euro cheapened, the dollar strengthened, right? It was less dollars to buy the euro, kind of a thing, right? You're looking here, less dollars. So this is the dollar strengthening all this time. Yet you have a strengthening dollar, and those are all the Trump years, right? And the dollar really strengthened 108 and that and then unfortunately you're seeing the reverse now. You're seeing a weakening dollar in 2021. Up to 120, up 122, 121, to buy a euro. It's supposed to be stable. It's supposed to be stable, and so you really had a dollar here in terms of again, same, going back to the definition of this. For 1 euro, what you're paying for 1 euro, you're going from 123, 112. The lower that it goes, the stronger the dollar is. Then you're spending, below a dollar. You're spending 99 cents or 98 cents to buy a euro. Okay, so now looking at that from the other way, the euro, again, this is relative to the euro. The euro, now this is not the whole global currencies or anything like that, but these are two of the biggest currencies that are out there. The euro would buy a lot of goods. So you had a stronger euro and a weaker dollar, back in 2018. So that was good for exporters. So in other words, as we were exporting, people could get a lot of, $1.12 of U.S. product versus 98 cents. Now they're getting 98 cents of of U.S. product for 1 euro. Okay, so looking at this, so obviously so the euro is weaker here. The dollar is really strong. Here, October, and then it flipped a bit. And now it's back up to 106, 107, thereabouts, that kind of a situation, looking at that. Okay, so it's moved around a bit. So again, so it's all relative. So relative to a dollar, relative to 107. So now, the euro buys $1.07 of goods. So that's a weaker U.S. currency and a stronger euro versus a dollar for, 1-to-1, where the euro was buying less. So that was a stronger dollar and a weaker euro. This is a stronger euro and a weaker dollar. Okay, so like I said, you got to keep that stuff straight in your, certainly in your head. But that's certainly a part of it. And so you're seeing, it says a lower path for the dollar more than offset. Lower path for the dollar. So obviously you have looking at something like this. The buying 1 euro, it takes less dollars. That's what they mean by lower path. So you have to, like I said, the terminology these guys use, it's got to be clear to somebody walking into, what do we mean lower, tighter, all these different terms that seem very anomalous. Okay, you want to be very, very, very certain and very, very clear. To buy a euro, it costs more dollars, less dollars, that kind of a situation. So again, if you're talking, $1.10 for a euro, if you're on the European side, you can buy a lot of U.S. products. If it's a dollar, the euro is weaker and the dollar stronger, you're getting less U.S. products. That's not as good for exporters. And on the United States side of that, if we went overseas to buy a euro worth of goods, it was really expensive a couple years ago, and it cheapened. The euro cheapened dramatically relative to the dollar when you're 0.1 versus 110, and that's about the movement that you're going to make. If this exchange rate varied or had a bigger percentage difference, any more than this, that would really be bad. because it's the currencies are not supposed to fluctuate this much. Okay, this is 10% is a big move for currencies. Okay, it's really a big move. And like I said, we always want to be sure about how we're, and then we can look at this up the other part of this here. So this is buying a euro. This is buying the dollar now. So again, so if the Europeans want to buy $1 of goods, it would take 0.8 euro. Now, with a strengthening dollar, almost 0.9 kind of a situation. So that's a weaker euro and a stronger currency, a stronger US, again, from the perspective of the Europeans, right? Their currency is weakened, our currency is strengthened. More euros to buy the dollar than previously. Before it's 88.8 euros, now it's 0.81, now it's 0.9, something like that. Stay in the cold. Yeah, down up to 0.9 now. And again, so to buy $1 worth of US goods, now it takes more euros, so it's a weaker, the European currencies, when it gets to 0.92, you're definitely weakening. Now it's strengthening again. 0.8, now it's down to, so again, but you're seeing a lot of fluctuation. Now it's over 1. So now for exporters, this is really bad, right? It takes over €1 to buy $1 of goods of US exports. How is that good? Okay, that's not good. Okay, at all. And don't let anyone ever tell you that this is good news. It's not good news. And this is directly what's happening with the Biden administration and Obama 3.0 are letting the conditions exist to make these exchange rates what they are. That's the truth. Okay, that's the truth. So, but yeah, so certainly, so equity, we looked at actual equity values, interest rates we've discussed. So the Federal Reserve said we're going to keep increasing interest rates. Okay, so certainly the behavior of the dollar, the behavior of equity values. Then it says, nevertheless, the forecast for U.S. through 2025 remains subdued. The CF lowered its outlook for potential output, reflecting lower expectations and trend in labor force participation. Well, labor force participation, again, we've looked at that. Let's see, BLS employment. That's average hourly. There it is. Labor force participation rate. This is this is unemployed plus employed persons divided by unemployed, employed, and not in the labor force. In 2008, we're at 66. And now we're down to 62. And what did these guys say they were thinking? They were saying a lower expected trend in labor force participation. Well, I mean, it's not moved a lot, but it's not moved in a positive direction. That's for sure. I mean, you could just do this just for a couple years, right? Just see what it looks like. Yeah. So it's now that dip was COVID. That dip was COVID. Let's see what that number looks like. But still down to 60 from 63. So, okay, but so that's labor force participation rate. So you're seeing an unfortunate dive in that. So yes, so the data does back that up. Okay, the data does back that up. The CF assumed a slower pace of decline in natural rate of unemployment over the near term in response to recent estimates suggesting that job matching efficiency was not improving as fast as previously anticipated. So yeah, so looking at that, a slower pace of decline. So yeah, so now it's not just the unemployment rate, but how much this changes is that's what they're really talking about. So this is a percentage change is what this is. Let's just grab a percentage. We should probably, I didn't realize that these guys thought this was important. So there we go. And then escape. So yeah, it didn't change. So you're taking the percentage change in unemployment, and you want it to go in a negative direction. But see, what they're saying is they're anticipating, which panned out. They're anticipating a slower rate of change, and actually, this is a negative rate of change here. So this, unfortunately, it increased here in October, and then this slowed from -5 down to a -2. So you're having the unemployment rate really plummet, and now it's about half that. So yeah, so that's something I probably got to put in there at some point. But again, you got fluctuations in this. You definitely so, but that's the rate of change of unemployment is what that is. A rate of change. And it says with these changes, output was expected to move below the staff's estimate of potential near. I'm saying with all these changes, output was expected to move below the staff's estimate of potential near the end of 2024, a year later than the previous forecasted, and to remain below the potential in 2025. Likewise, the unemployment rate was expected to be above the staff's estimate of its natural rate near the end of 2024 and remain above it in 2025. So, yeah, let's look at the staff expectation, the staff projections. Let's look at that. I didn't download those, but let's find those. Let's see, FOMC. So we're here. So we're 2022, and let's see what we have. Project. Yeah, these are the projection materials. We could just do the HTML version of that. And these, yeah, this is summary of economic projections, and this was as of December. So now, if you're looking at what's being projected, it's real GDP, unemployment rate, inflation, core inflation, federal funds rate. So the projection for the federal, by 2025 to sort of get back to a lower number, but for 2023, it's projected to be 5.1%, and for 2024, it's not that different. Okay, there were some September projections, but now the December projections were a little bit higher. You had September, and then you had the November meeting, right? So what'd you have? Yeah, you had September, November, December, and the projection only come out every other. So these only happen 4 times a year. It happens in March, it happens in June, in September after the retreat up in Wyoming, and then it happens in December. And it says right here, what are we talking? It says, in conjunction with the FOMC, the meeting held in December, meeting participants submitted their projections of the most likely outcome for the real gross domestic product, unemployment rate, inflation for each year from 2022 to 2025. See, 2022 to 2025, it's not 10 years, or it's not some crazy projection. And over the longer run, each participant's projections were based on information available at the time of the meeting, together with his or her assessment of the appropriate monetary policy, including a path for the federal funds and longer run value, and assumption about other factors likely to affect economic outcomes. The longer run projections represent each participant's assessment of the value to which each variable would be expected to converge over time. So that's a good math word. So, hopefully these guys know something about convergence and divergence and the math behind that. That's the next level. I mean, you don't really, I haven't encountered that too much in my post-mathematical career, but certainly when I was at the Rutgers math department, convergence and divergence were big pieces of the conversation all the time. Under appropriate monetary policy theory, or under appropriate monetary policy, and the absence of further shocks to the economy, the appropriate monetary policy is defined as a future path of the policy that each participant deems most likely to foster outcomes for economic activity and inflation that best satisfies his or her individual interpretation of the statutory mandate to promote maximum employment and price. And again, we see that Jay Powell has this on a tape recording: maximum employment, price stability, maximum employment, price stability. So now you have what the September projections were, and now you have what the updated ones were. So for better or worse, from September to December, the median projection for GDP change is half. For 2024, pretty much the same. 25 and the longer one were the same, but for 2023 there was a big seismic change there. Central tendency means sort of, it's not the range, but it's the most probable. I'll say it like this: it's the most probable range of the statistical computation of those values. So for 2022, we were looking at 0.2 to a fifth of 0.2 to 0.5% change. And September, so 2022 is a little bit better than the September projections. Unemployment rate, again, it's dancing around all those numbers, and I've heard conversations where people are saying that you really need 8 or 9% unemployment to get inflation back down, which I don't know if we're ever going to really be able to tolerate that. We wouldn't want that. So are people just hoping that it works itself out itself somehow? I have a terrible feeling that's what we're sort of dealing with. Inflation is supposed to come back under control by 2024, the end of 2023, but we're not anywhere near numbers like this yet. We're nowhere near these kinds of numbers. And up, from the September projections, we're up across the board. Same thing for core inflation, we're up across the board. In other words, for 2023 and 2024, The staff economists at the U.S. Central Bank figured the core personal consumption inflation would be higher than previously anticipated. Federal, again, projected appropriate monetary policy, 4%, 3%. But again, we've raised it to here, and I don't know if we're going to stop at 5. This projection says that, but we're already here, right? So if you look at the we're already at 5. So actually, these were the December numbers. The December range was 4.25 to 4.5, and if you look at where we are now, so this was the thinking in December, and actually, do we have the March ones yet? Projection, okay, I think we do have, we do have everything for March. It was just released. The March numbers, they're sticking with it. They're sticking with 5.1. Okay, they're sticking with all that stuff. And from December, not a lot of change from December, but they're sticking with that. But also, here's the statement. Here's the March statement. Where's that? We're already up to 4.75 to 5. So then we were going to stop, and we have a bunch. We have the June, July meetings. There's September, November. So there's about 5 more meetings, right? We had 3 so far. There's another 5. So we're not going to change at all. So I don't know how much to believe that if we're already up to the federal funds rate to 4.75 to 5%. But okay, we'll see sort of where we are with that. Yeah, so we looked at those. Now we get into the real interesting stuff. Now there's 2 more paragraphs here, which is fine. So actually, what we will do is we're going to transition to those financial accounting, the financial accounts table. So we're probably not going to hit this until the next video, until the 13th video, and it'll be all participants' view, because that's 1, 2, 3. Yeah, it's 4 pages. Okay, so that'll be a whole lecture. I don't want to break this up into pieces. So we're gonna hit this next time, because the staff economic outlook was a little short here. Now we're looking at price inflation, what the expectation was, core inflation, what that was expected to be. It was expected to be 5.5 in 2022. It was expected to be 4.7. The core one, both lower than the November projections. Well, again, let's look at where we are with that. So that's this. And these are the year-over-year. Again, this is the year-over-year projections. Yeah. So what does it say? It says, and the core. Where's the core? The core is here. Okay, we're 4.6. Pull that out. We can look at these 2. Control save. What does it say? It says 5.5 and 2022. Okay, 5.3. Yeah, 4.6, 4.7. All right, so we're pretty close. And actually, we were around those numbers in the new year, because we updated, because these are the monthly numbers. We updated some of that stuff with the effects of supply and demand imbalances in the goods market expected to unwind further, and labor and product market projected to become less tight. Staff continue to forecast that inflation would be decline markedly over the next 2 years. Core goods inflation is set to slow further. Housing services inflation was expected to peak in 2023 and move down, while core non-housing services was forecast to move down as wage growth eased. And it says in 2025, both the total and core inflation were expected to be near 2%. Wow, that's a couple years out, and good luck to making that prediction. It says, with inflation still elevated, staff continue to review the risk to inflation projections skewed to the upside. The sluggish growth in real private domestic spending expected over the next year, a subdued global economic outlook, persistently tight financial conditions were seen tilting the risks to the downside around the baseline projection for real economic activity, and the staff still viewed the possibility of recession sometime over the next year as plausible alternative to the baseline. So now I think we looked at some of the output numbers at the beginning of the lecture. Yeah, we saw how these were declining. So what are they talking about here? Real private domestic spending. Well, yeah. I mean, this is private domestic investment. It's not really, but okay, investment spending. That maybe another word for that. Um, yeah. So you're seeing a decline here. You had a decline there. A little bit of a bump up there, but you had this one. This was the equipment one. So if you're not spending on equipment, okay, you're not building up your manufacturing capabilities. And I think we initially looked at those. So uh, so that's all for the output or the economic outlook level or outlook discussion, which was really short. We have a longer one next time, but what we can do today, and we will, we're going to hit hard with Excel the financial accounts. Okay, so I think we left off at deposits. Right, we left off at deposits, and we'll work out the rest. So we'll go through the steps of doing all this again. So we're here 52, 27, 52, 12, 13. Yeah. So this we're done. This we have. And this is just for the eye, just for your eyeball to just sort of, not have to constantly look over there. And also, yeah, I think we're going to go to 20. We did the underlining for 20. So 184, 183 deposits. Yeah, Q120. Yeah. Oh, okay. We're going to pick up these. Copy. There we go. This thing, we're going to flip that. All right. Copy. And we're going to get hooked right into 2020. Okay. So there you go. So whatever numbers, what are we dealing with here? These are trillions. Yeah. So in terms of deposits, 8 trillion. So gone from 8 trillion in '08 to easily double, certainly on the way to doubling that. And this was 95, 98, 100, 102. Yeah. And again, the reason the current ones are a little bit different, or a little bit off, that's from 95 to 96 or whatever it is the personal income number is probably a little bit different. Is really what that is. Okay, so did that one next here. So 145. And these are directly held stocks. And what can you do with this? You can do is this. So copy. Special transpose value. Okay, we did that. And now we're going to do our division. Paste special divide values. Okay. That's 26. Okay, and look, oops. And this was 36, 25. Yeah, now we're good. Okay, so we worked on this thing. Bring it there. 9 is next. All right, that's 10 trillion, 10, 12. Yeah. All right. And we'll do this thing, sort custom, large, small, M. Copy, ooh, there we go, 149 or thereabouts. We'll do paste special transpose values. And this is indirectly held stocks, and you're seeing the numbers. I'm saying so you're getting some background in how to deal with these numbers. You do paste special divide values. Okay, and again, so we're going to cut this here. So what are we looking at here? You're looking at about 13 trillion or so. Whoops, we need. Okay, so we have all that. $60, 69, yeah, 69, 66, 72. Yeah. Okay. Directly held debt securities is next. So paste values. And again, we're going to take these, filter, custom. Special transpose values. Okay. Yeah, so those fluctuated a bit to the downside. Okay. Like 9, 21, 18. Okay. Folks, let me let you just stand by here for a second. Okay. Yes. So we did these. Two, three. There's four more, and we're gonna fit. It's good. We'll finish this today. And then you can look at the behavior of credit and people who hold stocks and all this other stuff. Now, another, these are all financial assets. These are indirectly held debt securities, defined benefit entitlements, non-core businesses, and then other financial assets. Deletion. So what do I have here? This is next. So 157. Assets indirectly held. Then we'll do transpose values. Okay. And then we'll do the division. So this is indirectly held debt securities. Now this is behaved. So again, all this stuff, there's so much. Now, again, I've looked at specific data that I think is important. We'll do divide values. But certainly now we've learned over doing this, working with these sort of meeting minutes a little bit more. The Federal Reserve folks look at what they think is important. and they put that on the St. Louis Fed. So you have to go really, all you have to do is go to the St. Louis Fed data site, and that's it. You have to go chasing through everything, sort of like I do. But I always overdo it. I always do that a bit in terms of the research, which isn't bad. I mean, considering, but like I said, I don't work for a group where there's a gigantic economic department. There's people with a lot of experience, but if I say something, I always want to check myself, because if I say something wrong, it's my reputation, my word, and once people don't say, hey, this guy has holes in what he says, that's never good. That's never a good thing. We're going to do 16 entitlements, which is next. Divide, special, divide, values. Okay. So yeah, this is 17 trillion and 91%. Let's check this. 17, 90, 91, 92. A couple years goes 96. Yeah, 96, 88. Good. Okay. I think we have 2 more to go. So see, again, you do things in pieces, right? You do these things in pieces. It's always a better way to hit it. Yeah, 2 more to go. So we did non-corporate businesses and other. Okay, so that's what's next. And this is 8s and 12s and 15s and 16s. We'll do paste, special, values, transpose. Yeah, so these are distinctly different here. Are these the same as those? No. These are distinctly different. Okay. Divide values. Okay. And there you go. Let's see these ratios. Are we 90, 89, 91? So yeah, about 89 is the fourth one. As long as we have 73 here. Yeah, 73. We're good. Okay. And last one. Last one. Other. So we'll do paste, special, transpose, values. We'll do another sort. Values, and then we'll do our division. There you go, and we're done. So we've filled in 18 financial account entries and did ratios and checks and all sorts of things. So let's see here. What do we have? We have some checks up here that we didn't look at before. This is a check for a lot of things. This looks like is this the non-financial? Yeah, those are all the financial assets, I think. Yeah, those are all financial assets, which are there. These are the ones up here, 129. The three non-financial assets ones, and we did assets and liabilities and equity. We did all those checks. This was these two added up. So this is what? This is liabilities. Yeah, that's assets. So I think that's the financial and the non-financial, right? I think we added those two up, I think. Yeah, non-financial, financial assets, fine. And all the liabilities entries are going to be next here. This was these three here added up. Those are all the liability pieces. And there you go. Okay. So yeah, and if this is quarter-over-quarter percentage change, what is this for? This is okay. This is the personal income. We didn't hit this model because it's just got a lot to it. So that's why we didn't work on it. But certainly, in future, I'm sure those other videos of where I have taught this. I got to sort through, find out where that was. But yeah, we've worked on that in previous videos. So okay, yeah. So this was a little shorter today. So the next one will be on participants' views on the current economic, on current conditions in the economic outlook. That'll be next. As we're sitting here, I'm just gonna. That's 301. Right, that's going to be a 301 version of this. So 301, 15. Data. And we'll get to that other stuff here. So but what we're going to work on today is this one. Okay. So that's 12. And we have to find something, some good text stuff to put in here. there. That's pretty good. So here we have the staff for December for projections, second half. Okay, so we have some good notes with this, and so there, like I said, folks, I'll be putting together the final exam work pretty soon. The questions maybe even tomorrow. So I'll work on them a bit, and we'll get that stuff out to you as soon as possible. Thank you very much. And the Zeke Sands of Pat podcast 300th episode, signing off. So there you go.